Welcome. My name is Julie Shoemaker. I am chair of the Dexter Community Fund Advisory Committee, and the Dexter Community Fund is happy to host this webinar on smart charitable giving strategies. I'd like to thank Melissa Joy, who is a certified financial planner with Pearl Planning and in Dexter, and an advisory committee member of the Dexter Community Fund, for sharing some smart giving strategies with us.
Thank you, Julie. I'm so glad to be here, and I want to be respectful of everybody's time. So we will get right started, but I do want to let you know that we will have questions at the end. You can always put them in the chat, or you can just wait and we'll give you time to voice your questions. And additionally, just thank you. You can follow up also individually with Julie, with Caitlin at the Ann Arbor Area Community Foundation, which will introduce in terms of the work they do with the community fund, as well as with me. And I'll provide my contact information at the end. So with that, let's get started. And if I could just get a thumbs up when you can see my screen. Can you see my screen? Okay, thank you very much. So on behalf of the Community Fund, thank you for being here. Today, we are going to talk about charitable giving in the context of changes that have occurred in legislation over the last 5 years. And then we're going to get right into charitable giving strategies, as well as how to leave gifts within your estate. And then some additional considerations when you are someone who is giving, who is charitably inclined. And then we'll conclude along with that Q&A that we promised. So getting right down to it, I think it's important to think about the landscape of gifting to nonprofits and tax-exempt organizations right now in terms of legislation that has happened over the last few years, because that has changed significantly the giving landscape. And one of the things to consider is that for many of us, we knew about charitable gifts not only for our inclination to do good for our communities and the organizations that are important to us, but also often you would get a tax deduction through itemizing with a charitable gift. And in 2018, the Tax Cuts and Jobs Act was passed, and that legislation significantly reduced the number of people who are able to itemize their deductions. And so that does not mean that you shouldn't be making charitable gifts, but it is a consideration, and it is something that people are still kind of getting used to. We've only had a couple tax years, and we had a big pandemic in the middle of everything. So I am going to be talking in context of the changes with the Tax Cuts and Jobs Act. Additionally, then at the end of 2019, there was legislation called the Secure Act, and it's hard to even remember this change because 2020 got in the way, but that significantly changed some of the rules for your retirement distributions, especially when you get older and are age 70 and a half used to be the required minimum distribution. It changed to age 72. Also, some rules changed in terms of when you receive a retirement account with an inheritance. So that is also something that I'll weave into the discussion, may change the desirability or which assets you might leave to charity in your estate. And then we had stimulus in the CARES Act over the last year, and perhaps more in the future, but that did provide a little relief for those who were used to giving smaller gifts and getting a tax break. So we'll talk about that as well. So let's get right into some charitable giving strategies. And there are 6 in particular that I wanted to mention today that I think oftentimes, since we're thinking about taxes, I'm going to go in context of taxes. And of course, I'll mention here that I'm a certified financial planner, not an attorney. So always consult with your attorney or tax professional when you're making your personal decisions. And we're just talking generally, not specifically. But then continuing on, we have some options for tax-aware giving. So the first thing I will mention relates to the last change, which was stimulus in the CARES Act. And as of last year, and it was continued this year, you can take advantage of a charitable deduction regardless of whether you had whether you were itemizing your deductions. So now there is a higher standard deduction, around $12,000 if you're single and $24,000 for joint filers. And so that has precluded some people from getting tax advantages with your gifts. But for this year, you will have the option for $300 deduction as a single person or $600 for those who are filing jointly. And so keep that in mind. You might not have thought to take advantage of that last year. So if you haven't filed your taxes and are waiting till Monday, that might be an opportunity. The next giving strategy is extremely popular, and it may be familiar to you if you have a required minimum distribution. So we're talking when you have a retirement account, especially, and in particular for this case, you need an individual retirement account, an IRA. You cannot do a qualified charitable distribution from a 401k. And for many years, this distribution has existed, but it was kind of being, it was limping along and staying alive with legislation from year to year. But recent legislation allowed the qualified charitable distribution to become permanent. And it was tied to the date when you became eligible to, or required, I should say, required to do a qualified charitable distribution, or to do a required minimum distribution. And that age was 70 and a half. I say was because legislation changed so that you do not have to take your required distributions now until age 72. But the legislation did not change in terms of the date that you could start doing qualified charitable distributions. So now they are on a different schedule. And after age 70 and a half, you are allowed to give up to $100,000 out of your IRA accounts. And while your normal distributions would go onto your tax returns, typically as ordinary income, in this case, you would not be adding that income to your returns. So in many cases, that would have an advantage over taking the money out of your IRA, giving it to yourself, and then writing a check to the charity. It would be more desirable to have the funds going right to your charity directly with this particular type of distribution. And then you will receive reporting on your taxes so that you know that those distributions, you do not need to report that income. So that is one pointer. Remember to mention to your CPA or tax preparer, or if you're doing your taxes yourself, remember that you did do a qualified charitable distribution. Reporting is getting better because in earlier years, because this was like kind of a case-by-case, year-by-year thing, you wouldn't even have a reminder on the tax documents you received from your retirement accounts. Fortunately, now there is more documentation. So that is a trigger to remember, oh, I did a qualified charitable distribution. But then it's, the charities just receive that money like a check. It works out very well for them. And in many cases, you may save on your taxes. Moving along, an additional gifting strategy that I think is probably underutilized is if you own stock. And in this case, we're not talking about a retirement account. So we're talking about a brokerage account, just an account where when you buy or sell something, you have to keep track of the taxes associated with your capital gains or losses. If you own an individual stock, an exchange traded fund, a mutual fund or a bond, or a variety of capital assets that are publicly traded, if you have appreciation in that stock, or I say stock, but in that asset, so perhaps you bought it for $1,000 and today it's worth $10,000. If you were to sell $10,000 and write a check to charity, you would potentially have a $9,000 capital gain. If you gave the nonprofit or charity your gift of the stock that was valued at $10,000 when you made the gift, then you would not pay a capital gain. And also the organization that received it, if it was a tax exempt organization, would not owe taxes when they sold the stock and used it for their good. So this is often underappreciated. I think one of the challenges is that you have to deal with some administration, right? You can't just be like, hey, here's some stock. You need to kind of link up with the accounts of the organizations that you will be giving to. But that is not an, it would be, I'd say perhaps a little bit onerous errand if you were just gifting $100 here and there. But if the money that you're giving is significant in terms of the amount, let's think definitely in excess of $1,000, but perhaps more, then you can link up with an organization and contact their financial manager and say, hey, I'd like to make a gift. Perhaps either you're managing your money yourself or you're working with a financial advisor, and they could coordinate so that you were able to give away that tax obligation to an organization that would not have to fulfill would not have to pay Uncle Sam when they receive the gift. Sometimes I see this and, you just don't even think about it when you're writing your checks to the organizations that you care about. So it's just sometimes not top of mind. People who may want to do this would be people, perhaps you have a lot of stock in your company, perhaps you receive stock options, you're a participant in an employee stock purchase plan where you receive a discounted value on the gift when you receive it. So there's a variety of kind of reasons that you might be eligible for this type of gift. And you may say, well, I do have a lot of so-and-so stock, but I also love that stock. Well, that's okay, because if you give away some of the appreciated asset and that has a really big gain, and then you write a check to your account when you otherwise would have been writing a check to the organization, you can buy that same stock and you would have reset your cost basis, the amount that you paid for that stock. So you would have a lower kind of tax obligation in the future. So of course, I don't know your particular circumstances, just kind of coming up with ideas. And if any of these are kind of sticking with you, I'd suggest that you talk it over with your professional advisors to see if one of these options might work. So a fourth strategy that comes to mind, because we have that issue where fewer and fewer Americans are itemizing their deductions, then you may be someone who was used to receiving the benefit of itemization and reducing your taxes that way. And perhaps you would want to do more gifts in one particular year and then skip a year. And you could coordinate with organizations. Maybe you made a pledge or had a traditional giving pattern and say, oh, you know what, this year is going to be the year where I really lump all my gifts in. You contact the organization and say, I really love you. I'm giving double this year, but that really is counting for 2021 and 2022. And so you're kind of aiming for itemizing in one particular year. And then, the organization gets a similar benefit. You may even decide to do it right at the end of the year. So it's kind of bridging that December to January gap, and it doesn't even feel very different to the organization. So I always think it's helpful to communicate, because as probably the people attending today know, as givers, organizations come to depend on the generosity of their donors. Also, though, sometimes that expectation, they expect it to be replicated. So it can be helpful to kind of communicate, oh, I'm going to be giving more this year because I'm kind of making a 2 or 3 year gift. And you may find that you have a particularly high tax year where you would be in a higher tax bracket. Some instances where I think of that, entrepreneurs have variable incomes and may have different incomes from one year to the next. In that case, you may be thinking to bundle in a higher tax year. Perhaps you're planning to retire, which may radically change your tax circumstances. And in some cases, I've even worked with people who might make gifts that would be the equivalent of 5 or 10 years of their intended giving in a particular year, which can kind of move us along to the next kind of opportunity, which is called a donor advised fund. So with a donor advised fund, this can be a way to assist you with both appreciated stock or bundling your gifts over many years into one particular year. because basically it is a type of account that is pretty simple or straightforward to open. These types of accounts are available at a variety of places. For example, you could open a donor advised fund with the Ann Arbor Area Community Foundation, which happens to be the sponsor or the place where we keep assets for the Dexter Community Fund. Big brokerages like Fidelity or Vanguard, or I custody assets with Raymond James, they all have donor advised funds as well. So the donor advised fund is basically an account where you put money in. You could write a check or you could give stock. And that when you put the money in, you get a tax deduction. So that is fully within your control. You decide when you get the tax deduction. At that point, some people turn around and start writing checks to charities and nonprofits right away. Other people may choose to give over time or may not even know when they would be making that gift. So in the meantime, the donor advised fund is typically invested on behalf of the future gifts. So it has the potential for growing. It could be, especially if you were in that high tax year where there was a significant event, or you just are planning to retire or have lower income in the future. It allows you to lock in your deduction at a particular time. And then you have a substantial amount of control over when you would be giving. Now you are giving up some control. You can't just say, I want to do over, I'm going to need that money to go back into my account. You are giving that money away. And then the donor advised funds manager, whether it's the Ann Arbor Area Community Fund or Fidelity, et cetera, they have a committee that endorses gifts. And what they do is they make sure that the gifts are going to tax exempt organizations that are in good standings. And they're also making sure that you're not fulfilling a pledge. Actually, they have, there is IRS language that says you can't recommend a donation from your donor advised fund for money that's committed like a pledge. When I have a donor advised fund, and when I make a gift, when I tell an organization I intend to give, instead of saying that I pledge to give, for example, for my church gifts or for the Dexter Community Fund, I will say I have an intent to give. And so I'll write that down. I'll cross out pledge and say intend to give. And then I will recommend a gift with my donor advised fund. So then you can, then you get the benefit of some ease of receiving appreciated stock. So these funds are kind of set up to be a receiver of both cash or stock. And then you also, if you wanted to make a big gift in this year, but you wanted to kind of parse out when you gave money to organizations, then the donor advised strategy is one way that is becoming increasingly popular, because you don't have to hire a team of attorneys to draft things, and you don't have to do reporting like you would with the IRS for a family foundation or more sophisticated strategies. Now, the sixth way that I wanted to mention, more sophisticated estate planning strategies could include, depending on the size of gifts, family foundation, charitable lead trust, charitable remainder trust. In this case, you're likely working with an estate planning attorney and really making long-term decisions. And there would be perhaps more administrative management, but there can also be big advantages. And I know that the Ann Arbor Area Community Foundation also has some of those types of accounts as well. The other thing that I would mention that's a magnifier for giving, it might not be a tax strategy, but it is a strategy that I know organizations I've worked with in the past have really benefited from, is that if you have corporate matching at the company that you work for, and you are also charitably inclined, that coordinating so that you are able to magnify your gift with that, the gifts from the corporation can also be a terrific way to have a bigger impact with your gifts. So moving along, we also wanted to touch on briefly estate gifts. So gifts that were left at your death. legacy gifts. And I think that these types of gifts can be extraordinarily impactful. They also, instilling a sense of giving to next generations and kind of the family values of why community and supporting organizations you care about are important is a wonderful, it's kind of at the heart of many lessons for children who are inheriting wealth or adult children who are inheriting wealth. So I think that there's some, there's some intrinsic good that goes with bequests and legacy gifts. So there are several strategies, and this gets back to the legislative changes that occurred in the Secure Act as well. So one option you might have would be to say, there's an organization that's really important to me, and I would like to just leave details in my will or trust where I ask for a gift of either a certain amount or percentage to be given to an organization. One of the benefits of these types of strategies is there's nothing that you typically, and it depends on the type of legal document, but oftentimes you can amend or revoke your intent if you updated your legal documents later. And, there's a variety of ways to think about what you might give. I once heard someone who said they thought about their church or another organization that they really was extraordinarily important to them as an additional child in their legal documents. For other people, it could just be a gift of $5,000 or $10,000. It may be a percentage. And so all of these are options to consider. Additionally, because we have a change to the rules for when you receive retirement assets now, instead of having a lifetime to take those funds out, if you are a beneficiary for a 401k or an IRA, now you have 10 years when you receive a beneficiary IRA if you're not a spouse. So the clock starts in the year the person passes away, and you could wait until the 10th year and have all of the money go out then. But if you already had an intent to leave some money to important organizations, there is a tax bill when you leave money in an IRA to your children or other people. There is not a tax bill when the organization receives it. So if you had the intent to give in your will or trust, you might reflect and look back and say that we could maybe identify the particular place we'd like to give from and perhaps leave it in a beneficiary designation in your retirement account. Also, you may want to consider how you would document a gift. So there are some pros and cons. I know that nonprofits love to know that you have decided to make a legacy gift. That is important for their, planning, and they also love to appreciate you within your lifetime. Additional considerations, though, are: do you legally require yourself to make that gift? And what if your relationship with the organization changes? So there's a variety of options. You may say, hey, I'm planning to give, but not give them particular details. You may go and really make a legal document that says that this gift is intended to happen upon my death. So just consider the advantages. And I also always encourage you, if the relationships feel right, and to communicate with the other participants and members of your family or other people receiving funds from you in bequests, so that they understand the importance of the organization, the importance of the gift, and also so they are not tempted to kind of intervene and make adjustments to your thoughtful estate plan. And how much control will you have over your gift? That goes back to, do you leave instructions to say this gift will be used for something in particular? Or do you make it so that, I know organizations love when there's flexibility in a gift so that they can be sure they can fulfill the obligation. But there's a give and take there in terms of whether there are strings attached or not. So other considerations that I think are important for you to think about as you're developing your giving strategy. First of all, I know it can seem like hard work, but I think it's very rewarding to document and refine your giving philosophy. You don't have to do this every year, but it can be an extraordinary discussion, either individually or within a family, to talk about your family values, the organizations that are important to you, what fills you up, are your values aligned with your gifting? Like I said, there's also, if you're able to include the next generation or start to have them doing some gifting themselves or give them some control over gifts, that can be just a fantastic way to start to instill meaning and purpose to money, and have really extraordinary broader discussions as a family. Also, as serving on a committee of an organization that really loves Dexter and does meaningful things for the community, I think many of us here can recognize the value of developing a relationship with the organizations you care about. Volunteering really is hard work, but also extraordinarily, it pays you back. And so develop a relationship with the organizations and causes that are meaningful for you. It doesn't just have to be a financial relationship. It can be more than that. I think of a client that I work with who has served on the board of Leader Dogs for the Blind and also raised a leader dog who was graduated and served someone. And then when it was time for the dog and the person the dog served to part ways, returned home to my client. And it was just, it really gave back to the whole family. So developing a, kind of multifaceted relationship with organizations can be quite fulfilling. And then finally, just a reminder that your personal circumstances will change over time. I've talked in context of 2021, and there's a slew of potential legislative changes that could either increase the impact of one gift versus another. There's potential changes to capital gains, tax rates, things like that. So think about, make sure that you're coordinating with a professional to identify opportunities. And those professionals are often your estate planning team, your CPA or tax preparer, or your financial planner. So with that, I promised you that we would make some room for questions, but I want to make sure that since this presentation is sponsored by the Dexter Community Fund, where to find us. We are at dextercommunityfund.org. And then in terms of additional resources, Julie Shoemaker, who's going to hop back on as we do Q&A, is, well, Julie, would you mind if I pin you and then you talk a little bit more about the community fund?
That would be fine.
Great. I'm going to stop the share and I'm going to put back up these contact details after we finish Q&A as well. But do know that the Community Fund and Ann Arbor Area Community Foundation and also myself are all available if you have follow-up questions that you don't want to kind of share with a larger group. Okay. Oh, there you are. Good.
Great. So I just want to spend a few minutes sharing information about the Dexter Community Fund. The Dexter Community Fund is a permanent endowment dedicated to addressing community needs and enriching the quality of life within the Dexter community. The fund was established in 2014 as a geographic field of interest fund with the Ann Arbor Area Community Foundation. As an endowment fund, the principal is invested and the interest earned provides grants to local nonprofit organizations and community projects in perpetuity. In 2018, Dexter Community Fund conducted a needs assessment, and we identified 6 areas as priority areas for grant making. And that was services for seniors, mental health, services, improved outdoor recreational opportunities, programs for teens, services for the homebound, and programs to enhance arts and culture. And to date, the Dexter Community Fund has made grants to numerous organizations that have served our community: the Dexter Senior Center, Grieve Well to provide workshops to support healthy grieving, Girl Scouts, His Eyes on the Sparrow, which is a home residential housing for adults with developmental disabilities, Center for Independent Living, which launched together in Dexter to diminish the social isolation of young adults with disabilities in our community, Faith in Action, and Dexter Community Players. So just a couple, many folks, we give grants or we make donations to individual organizations. And someone might wonder, why make a donation to Dexter Community Fund rather than the individual organizations themselves? Dexter Community Fund can address a variety of community needs and has the flexibility to address new needs in our community as they emerge. We can also support smaller nonprofits that don't have the capacity to fundraise on their own. Additionally, we're able to provide grants from a single pool of funds to benefit our community forever. And lastly, it provides an opportunity to leave a legacy in the community for future generations. And as Melissa had mentioned, if you'd like to learn more about the Dexter Community Fund, you can go to dextercommunityfund.org. You can also sign up for our twice-a-year newsletter there as well. And if you have any questions, feel free to reach out, and either myself or Caitlin Vedetto with Ann Arbor Area Community Foundation, or Melissa Joy, if it has to do with particular financial matters and tax planning, could help you in that regard. So are there any questions? I am not seeing any questions.
Well, I've opened up the chat too, if anyone's feeling shy but had a follow-up question. But give me a thumbs up or down. Did anyone learn anything new in our conversation today? Good. Well, I'm going to share with Julie a checklist that is just a very top level checklist of ideas to think about when you're giving charitably. So it goes over some of the types of programs that we mentioned. And it also talks about, just your values and making sure you're aligning things. The reason that you give is not because of taxes. The reason you give is because you care. And then all the tax considerations come after that. But if you already have the intent, then why not also take advantage of, the financial opportunities that come along with it. And so I would just like to mention that, revisiting lists like that can be very helpful. If you ask Julie as a follow-up, she'll be happy to provide that list to you, or feel free to email me and I'll send it over to you as well.
Could you put that contact info back up for another minute in case
yes, I can.
Didn't catch it?
Here you go. And let me just make sure I didn't miss any questions. We really appreciate the turnout, and we're also going to have this as a recorded video so that we're able to share it with a broader audience. So if you need a copy or have someone that you think would appreciate the content, please don't hesitate to share it. It'll be in our upcoming newsletter.